Morning, everybody. The June 18, 2019 School Land Board meeting will now come to order. I want to welcome our guests and those that may not have filled out a visitor card. I want to also welcome Mr. Maynard with the State Board of Education. First item on the agenda is approval of minutes from May 7, 2019 School Land Board meeting. Mr. Warman was not in attendance on that meeting, so it would require a motion from Mr. Borsiaga or myself to confirm said minutes after we've had a chance to review them.
Motion to approve.
Second. Motion is made, seconded, and with one abstention to approve the minutes. Next item on the agenda is approval of the consent agenda. I've not been notified of any last-minute changes to the consent agenda, and assuming the board has had a chance to review, and assuming no questions, comments, concerns, I could entertain a motion to confirm said consent agenda as posted.
Said motion.
Second.
Motion is made, seconded, and carries unanimously to approve the consent agenda as posted. Items 3 through 7 will be held in executive session, and we'll enter into it according to Chapter 551, Subchapter D, Section 551, Tech 071 of the Texas Government Code for discussion and consideration regarding pending or contemplated litigation or settlement offers, and also to seek or receive attorney advice or counsel related to items 3 through 7 on the docket. We'll also enter into session under subsection 551, Tech 072 for discussion and consideration concerning purchase, sale, exchange, lease, or value of real property related to items 3 through 7 on the docket. Following executive session, we will reconvene in open meeting. The open session of the June 18, 2019 School Land Board meeting will now resume with item number 3.
Morning again. Larry Hargrave with the Oil and Gas and Energy section of the Office of General Counsel. I recommend that the board approve agenda item number 3 as discussed in executive session. I'm happy to answer any questions.
Is there a motion to approve?
Motion to approve.
Second.
Motion is made, seconded, and carries unanimously to approve item number 3. Thank you. Next item on the agenda is number 4.
Good morning, Amber Long, Asset Management. Staff recommends approval of the disposition of excess land as being in the best interest in the permanent school fund as discussed in closed session. Any questions?
I motion to approve.
Second.
Motion is made, seconded, and carries unanimously to approve item number 4. Next item on the agenda is number 5.
Amber Long, Asset Management. Staff recommends approval of the disposition of excess land per the terms discussed in closed session. Any questions?
Motion to approve.
Second.
Motion is made, seconded, and carries unanimously to approve item number 5. Next item on the agenda is number 6.
Amber Long, Asset Management. Staff recommends approval of the disposition of tax foreclosure land per the terms discussed in closed session as being in the best interest of the state. Any questions?
I motion to approve.
Second.
Motion is made, seconded, and carries unanimously to approve item number 6. Next item on the agenda is number 7.
Amber Long, Asset Management. Staff recommends approval of disposition of tax foreclosure land per the terms discussed in closed session. Any questions?
A motion to approve.
And second.
Motion is made, seconded, and carries unanimously to approve item number 7.
Thank you.
Amber. Final item on the agenda is a quarterly investment report. This is a non-voting item.
Thank you, Mr. Chairman. Members, for the record, Rusty Martin, Chief Investment Officer. You've been moving along very quickly here, but I'm going to slow you down a little bit. Hope you don't mind that. I'm pleased to present you with the quarterly investment report of the TexGlo Permanent School Fund Investment Portfolio for the period October 1 through December 31, 2018. The performance measurement calculations and statistical data that are presented in the report were prepared by State Street Bank and its private edge group, which are the custodial accounting and performance measurement agents for the portfolio. I'll give you a brief summary of economic conditions in general and then talk in a little more detail about conditions in the commercial real estate market and in the energy markets. Then we'll talk about performance numbers during the quarter. Fourth quarter U.S. GDP increased at an annual rate of 2.2%. That was after increasing 3.4% in the third quarter of the year. U.S. unemployment rate ended the quarter at 3.9%, up slightly from 3.7% at the end of the third quarter. And the Fed raised its target Fed funds rate range again. It was at 2 to 2.25%, and they raised it a quarter point to 2.25 to 2.50, and that was at their December meeting. They also sustained their continuing balance sheet normalization program, which, as you know, concerns the reinvestment of principal payments from its holdings in agency mortgage-backed securities and the rolling over at auction of maturing Treasury securities. They also agreed that the timing and size of future adjustments in Fed funds would depend upon their assessment of realized and expected economic conditions relative to its maximum employment objective and symmetric 2% inflation objective. In the real estate market, as measured by the unlevered NPI, which is a NCREIF property index, it returned 1.37% for the quarter. Into December 31st, its trailing one-year return was 6.71%. Occupancy was down just very slightly during the quarter, still very high at 94%. It was about 94.2% before that. Cap rates edged up a little from 4.79% to 4.81%, and rent growth came in at 1.5% versus 0.7% for the third quarter. As far as the returns in the individual NPI sectors, hotel was at 1.21% for the quarter. Retail actually was a minus 0.43%. Apartments were up 1.35%. Industrial continued to be strong, 3.40% for the quarter. And then office was at 1.65%. Just to note, that is the first quarter that's seen a negative return in any of the sectors since the fourth quarter of 2009. So it's been 10 years since there was a negative return in any of those sectors. Industrial, again, was the best performing sector, and that's, of course, due to the continued strong performance of industrial warehouse space. In the energy markets, rough quarter for oil. WTI spot crude prices averaged $59 a barrel during the fourth quarter, but they ended the year with a very sharp drop down to about $45 a barrel. It represented a 38% decrease from the third quarter ending price of $73 a barrel. That's the first time since 2015 that crude oil prices ended the year lower than where they started. This decrease was primarily caused by increased oil production by Saudi Arabia, Russia, and the U.S. to near record highs. Waivers granted to certain countries that import crude oil from Iran. Perceived slowing global economic growth and its likely negative impact on future crude oil demand, and the opening of Plains All-American's Permian to Cushing Sunrise Pipeline in November of 2018, which added somewhere between 300 and 350,000 barrels per day of U.S. incremental takeaway capacity. As far as natural gas is concerned, prices ranged from $3.25 per million BTUs to $4.70 during the quarter, and they averaged $3.78 during the quarter and ended at $3.26. So that was about 8% above the third quarter ending price of about $3.01. Medium-term price upside potential remains limited, however. That's given continuing strong domestic supply growth, which is expected to continue to exceed domestic demand. However, most analysts continue to think that rising industrial demand, LNG exports, increased exports to Mexico, and continued coal to gas switching will foster long-term supply and demand support. If you turn to page 2 of the report, it's a performance measurement summary. We'll go through those numbers. First thing you will notice is that the portfolio NAV, including cash, was about $7.68 billion. The portfolio itself was about $3.6 billion, and the cash equivalents was about $4.1 billion. As far as the performance is concerned for the quarter, reflecting the huge decrease in energy prices, we were down 1.81% for the quarter versus an increase of 0.81% on the benchmark. So we underperformed the benchmark by 100 basis points for the quarter. That purely is a reflection of energy. Energy portfolio, our energy portfolio was down just under 7% for the quarter. And of course, that's primarily related to a 38% decrease in WTI spot oil prices during the quarter. Real estate, our real estate portfolio was actually up 3.5%, and the infrastructure portion of the portfolio was up 1.35%. I think, just point out, we're going to see some volatile quarters in the energy sector. We know that the first quarter of 2019 there was a big recovery in the energy sector, so we're going to see our portion of the energy of the portfolio devoted to energy is going to have a pretty big increase in the first quarter of 2019. As far as the longer,
Would you please say that again, about the first quarter?
oil prices recovered very strongly during the first quarter of 2019. So with regards to our energy section of our portfolio, we're going to see a resulting increase in that value.
So you're saying that the increase from what was 45 to 52, which is currently, is that what you?
Yeah, it'll be reflected, that increase in oil prices will be reflected as a write-up in our energy portfolio for the first quarter when those numbers come out. As far as longer-term returns go, the one-year return on the portfolio, and I'm talking about gross returns without cash here, the one-year return was 10.35% versus 6.32 on the benchmark, so we outperformed the benchmark by 403 basis points. The individual one-year sector returns for the portfolio, so energy was still up almost 10% over the one-year period. It was up 9.65%. Infrastructure was up 8.76%, and real estate was up 10.82%. Three-year return, 15.53% versus 6.43 on the benchmark, outperformance of 910 basis points. Five-year average annual return, 14.13% versus 7.50 on the benchmark, outperformance of 663 basis points. We now have 10-year return numbers, which are not in the report, but which we were going to start adding to the report, beginning with the next sector. Our 10-year return, feels kind of funny saying our 10-year return, it's 10.91% versus 4.85% on the benchmark. So about a 2.25x on that, outperformance by 606 basis points over the 10-year period. And as I said, we're going to start adding the 10-year returns to our quarterly investment report. At the end of the year, about 40% of our total existing capital commitments were unfunded, and that translates into just under $3 billion. 37% of real estate, 44% of infrastructure, and 39% of energy commitments were unfunded. If you turn to page 3, there's a summary of the new investments that the board approved during the quarter. And as you recall, you approved 2 new fund investments, one in non-core real estate and one in energy. Those 2 investments totaled $450 million. And then you approved the expansion of an existing Core Plus real estate investment from $75 million to $200 million. In the first quarter of this year, the board approved no new investments. Turning to page 7, we can look at the portfolio allocations by asset type, pages 7 and 8. So on a purely invested basis, the portfolio was slightly underallocated to real estate. At December, it was at 32% versus a target at 33%. Infrastructure was at 26% versus a target of 32%, and energy was at 42% versus a target of 35%. The low infrastructure allocation is primarily due to several monetizations in that sector of the portfolio that resulted in significant amounts of capital being returned. However, these allocations will continue to change over time and become more aligned with our target allocations as more of the unfunded capital commitments to infrastructure become funded. For example, if you turn the page to page 8, you'll see that if we consider the allocations on an invested plus unfunded commitments basis, real estate allocation was at 28% versus a 33% target. Infrastructure was at 30% versus 32% target, and energy was at 42% versus 35%. Turning to geographic diversification, which you'll see on pages 11 through 12, portfolio is close to the targeted allocation for each region. Currently, we're about, the allocation to the U.S. is about 94% versus a target of 90%, and the international allocation is currently around 6% compared to a target of 10%. Turning to page 13 and 14, looking at our portfolio investment manager exposure. On a purely invested basis, we're well diversified across a platform of 25 different investment managers. Our investment policy statement limits the exposure to any one manager to no more than 20% of the total. The portfolio investment manager exposures at the end of the year are well within that range. The top 5 highest exposures are USAA Real Estate at 10.2%. That's followed by InCap Energy at 9.56%. InCap Flat Rock Midstream at 7.71%, Macquarie Infrastructure Partners at 5.43%, and BlackRock at 4.72%. The co-investment vehicles are grouped by manager and presented separately. The highest grouped co-investment exposures were First Reserve at 8.46%. That was followed by InCap Flat Rock Midstream at 5.31%. and Intervest at 4.62%. That concludes my presentation. This is a non-voting item, but I'm happy to answer any questions you may have.
Rusty, with you know, your profile at 41% on the energy side, and with hydrocarbon prices kind of being depressed and not looking too good in the near future, have these private equity funds, have they kind of pulled their horns in? Are they still going out trying to raise money, or they're going to kind of, because I mean, I know they're all having problems internally with their upstream companies. What's your knowledge of that?
So my answer to that question is there are always opportunities in the market. So when things don't look good from a certain perspective, they look good from another perspective. So yes, the answer is yes. There are still people that are raising money now. I would say the fundraising, though, so raising for commingled funds, you're not seeing a lot of that right now because that cycle that went through that cycle, and it kind of ended about a year ago when there were a lot of them that were in the market raising commingled funds. Mm-hmm. What we're seeing now is more kind of rifle shot, targeted approaches, more on a separate account basis or a club basis, where there are certain opportunities in the market because of the pricing that have a short window open, and you see entities that are trying to raise capital take advantage of those very short-term windows. So yes, they are still raising money, and there's still drilling going on too. People are still running rigs. I know they're not running as many rigs, but there's still a lot of activity.
Well, yeah, with the upstreams having to operate within cash flow, within the GLO, as far as your group, do you guys form your own fundamental view and therefore determine, okay, we're going to kind of pull back on the energy side, or how do you measure that?
So we use the allocation targets and the allocation measurements to inform the Investment Advisory Committee. So every year in January, typically, the Investment Advisory Committee has a strategic meeting and determines what its focus is going to be for the year across each of those 3 sectors, and then makes allocations about how much capital to try to commit to each of those sectors. So taking that into consideration, our focus this year, energy would be at the bottom of the portfolio. We targeted $300 million out of a total of $1.5 billion to go into energy. So we just adjust the amount that we're going to commit on an ongoing basis.
Got it. Thank you.
Any other questions from the board? This being a non-voting item and considering no other business before the board, the meeting is hereby adjourned.
Thank you, Mr. Chairman.
Thank you, Rusty.